if the investment strategies you've always trusted are missing a crucial element? I've been a financial advisor for over 30 years and a portfolio manager for over 15 years, and I've recently taken the uncommon decision to shift my priorities. I'm John Goey, portfolio manager with Design Securities and the host of the Make Better Wealth Decisions podcast. Over the course of my career, I've spoken out on countless occasions about the importance of managing costs. The financial services industry often goes out of its way to conceal this importance because what's called a cost to an investor is known as a profit margin to a product manufacturer and to the financial services industry in general. I've written a book called Bullshift that shows how the financial services industry shifts your attention to make you feel bullish. Having a positive outlook is just good for business. The thing about perpetual optimism is that it's not realistic. The industry's commercial imperative causes it to relax its commitment to transparency and truth in the pursuit of greater profits. The financial services industry also pretends that it's always a great time to invest because it always wants to be managing more money and gathering more assets. We got to use critical thinking to be more skeptical. It's one of the great truisms in personal finance that, in the words of Vanguard founder John Bogle, you get what you don't pay for. In other words, the less you pay for financial products and advice, the more you get to keep. Stated plainly, if you can cut your costs by, say, 1%, then you're likely to increase your returns by that same 1%, holding all else equal. Within the financial advisory community, I've been one of the most vocal advocates for keeping costs low and for educating the public about the importance of cost. A funny thing happened as 2019 gave way to 2020. A new consideration appeared on my radar that was not only highly distressing, but which caused me to reorder my priorities in terms of the recommendations I was making. That new consideration was and is valuation levels. It appeared to me that stock markets had become extremely expensive at the end of the second decade of this century, and I, for one, became concerned that people were exposing themselves to risk that might otherwise be avoided. Getting cheap exposure in terms of product cost to expensive markets in terms of security valuations was a risky proposition that I felt uncomfortable in condoning. Starting in early 2020, I began to reposition my clients' portfolios toward alternative asset classes and alternative strategies that I felt offered a better risk-return trade-off given the circumstances of the day. I have not abandoned my commitment to managing cost. Balancing competing priorities involves thoughtful reflection in light of changing circumstances. A lot of soul-searching went into my decision. There's a good deal of academic research that I relied on. For starters, risk aversion, which is a subset of prospect theory, shows that the pain of a loss is twice as acute as the joy of a gain of equal magnitude. This finding was a significant part of what landed Daniel Kahneman a Nobel Prize in Economics in 2002. You may know Kahneman through his groundbreaking book, Thinking Fast and Slow. I learned from personal experience during the global financial crisis that clients will not always rebalance back to their target mix, even if it was mutually agreed upon in writing in advance. Rather, when faced with the stress and fear associated with seeing their nest egg deplete, most refuse to take the opportunity to reposition their money into those asset classes that were temporarily out of favor and on sale. The best advice in the world is of no value if you can't get people to take it. There's more. The cyclically adjusted price-earnings ratio, or CAPE, of the S&P 500 was then and remains now at historically high levels. Evidence surrounding CAPE was pioneered by Professor Robert Shiller, the author of a book called Irrational Exuberance and the winner of the 2013 Nobel Prize in Economics. Historically speaking, when a CAPE reading is in the mid-30s or higher, the average annualized return for that market is often very close to zero for the following decade. In other words, it seemed as though we might be in for a prolonged bear market once the readings became excessively high. Although that has not come to pass yet, it is my considered opinion that the likelihood remains high. There will come a day when valuations will not be as stretched and the need to be defensive will be reduced. When that happens, I fully expect to resume going about portfolio construction using more traditional products and strategies based on my renewed emphasis on keeping costs down. For the time being, however, I've chosen to err on the side of caution based on valuations and to be cautious about the risk I expose my clients to.